Welcome to this explainer. If you absolutely love understanding how the gears of a business turn, well, you're definitely in the right place. Today, we're taking a journey. We're going from the kind of chaotic world of disconnected bookkeeping straight into the streamlined, highly efficient reality of modern accounting. We're going to see exactly how businesses evolve to track their costs without, completely losing their minds in the process.
Okay, let's dive into this. Here's our roadmap for today. First, basics of cost bookkeeping. Second, the interlocking system. Third, reconciling different profit figures. Fourth, the integrated accounting system. And finally, account codes and computers.
Section 1. Basics of cost bookkeeping. Beyond external reports.
So while external financial reports definitely keep the tax man happy, which is important, internal cost tracking is literally a business's daily lifeblood. It's how they survive. Any system out there needs to capture a pretty simple conceptual flow. Think of it like a giant puzzle. Step 1, raw materials. Imagine, say, a raw block of wood. Step 2 is work in progress, where direct labor and factory overheads are absorbed into the cost as you cut and sand that wood. And finally, step 3, finished goods, totally ready for sale. The ultimate goal here? Tracking this entire transformation without getting tangled up in super complex ledgers.
Section 2. The interlocking accounting system. Two separate worlds.
Historically, businesses relied heavily on what's called an interlocking system. Imagine the financial department and the cost department operating in total isolation. Basically, it's like two departments speaking completely different languages under the exact same roof. Because of this, they desperately needed a translator. Enter the control account. It's a summary account in the main ledger that literally acts as a bridge between these two systems. So the financial ledger control account actually lives in the cost ledger and vice versa. They mirror each other, interlocking just enough to pass vital data back and forth.
Section 3. Reconciling different profit figures. The accounting headache.
Now, here is the massive, undeniable problem with keeping two separate sets of books. At year-end, both departments calculate a profit, and guess what? They inevitably disagree. Consider this scenario from Nuance Limited. The financial accountant proudly reports a profit of 17,500 naira. But wait, the cost accountant walks in claiming a profit of 21,750 naira. I mean, who's actually right here? Why do the numbers clash so dramatically?
Well, the culprits actually lie in the completely different rules that each department follows. First up, appropriations of profit. Financial accounts include things like corporate tax and dividends paid, which cost accounts completely ignore. Second, purely financial matters. Interest on bank deposits or, say, rent receivable simply don't belong in a factory's manufacturing cost calculations, right? And finally, differing treatments. For instance, the cost accountant might value inventory with overhead included, while the financial accountant values it strictly at prime cost.
To solve this mystery, businesses had to build a memorandum reconciliation account. And let me tell you, it is a painstaking journey. You have to take that financial profit of 17,500, add back the differing inventory valuations, subtract out items like discounts, and basically, step by step, prove that both accountants were actually, technically, correct based on their own specific rules to arrive at that 21,750 figure. I mean, you could almost hear the collective groans of the accounting department, right? What a massive waste of time.
Section 4. The integrated accounting system. One universal language.
So instead of spending days reconciling two totally different profit figures, what if we just threw out the separate books entirely? Actually, scratch that. It's exactly what modern businesses did. The Chartered Institute of Management Accountants, or CIMA, defines this elegant solution as a set of accounting records that integrates both financial and cost accounts using a common input and data for all accounting purposes. Boom! No more translators. Everyone in the business is finally forced to speak one single universal language.
Now, what's really interesting about this is the stark contrast between the two. The old reliable interlocking system meant separate ledgers, it required a control account translator, and it forced painful periodic reconciliation. But contrast that with the integrated system. You get a unified set of accounts, common input data, and absolutely no reconciliation required. Why? Because there is only ever one profit figure generated. The sheer amount of administrative effort saved here is absolutely staggering. But you might be wondering, is there a catch? Well, yes. This single system must serve two fundamentally different and honestly sometimes conflicting purposes. Purpose 1,
external stewardship and reporting, which absolutely requires strict, rigid adherence to international accounting standards. Purpose 2, internal management and control, where cost managers need real flexibility. So an integrated system has to be brilliantly designed with modified subsidiary ledgers to perfectly balance those strict external rules with flexible internal needs. It's quite the balancing act.
Section 5. Account codes and computers. Scaling with tech.
Okay, so now that we have this one massive, integrated system holding literally every transaction, how on earth do we track all this data without completely drowning in it? The answer is codification. By creating logical sequences, we organize data perfectly for computer systems to process. For example, land might be coded from 0000 to 0099, buildings from 0100 to 0299. If an invoice comes in for the heating plant, boom, it's immediately slapped with a 0700 block code. It makes data entry blazing fast and perfectly tailored for modern databases.
And of course, computers are the true engine of modern integrated accounting. We generally see two main types of systems doing the heavy lifting. First, transaction processing systems. These handle the massive volumes of monotonous daily data centrally, but their flexibility is pretty low. Then we have decision support systems, or DSS, which offer high flexibility. Think of the ultimate electronic spreadsheet. Yes, good old Microsoft Excel. A DSS empowers a cost accountant to interactively manipulate complex data, guiding managers to the right conclusions without ever needing a programmer. It's a real game changer.
So we've traveled from the clunky, disconnected ledgers of the past, we suffered through the headaches of reconciliation, and we finally arrived at the incredibly streamlined, computer-driven, integrated systems of today. So I'll leave you with this final thought to ponder. As technology effortlessly integrates all our financial data into one ultimate system, what new efficiency insights will your business discover? Thank you so much for joining me on this explainer, and keep learning.